Last year, Oracle spent roughly $35 billion on building AI data centers, out of which 65% went into buying servers, GPUs, and other equipment, and the rest was spent on land building and construction. Google, on the other hand, spent roughly $91 billion, out of which 60% went into equipment. Now, the share price of Google is going up, but it's the opposite for Oracle. Let's say you are not a professional analyst and a lazy person like me, and don't wish to comb through hundreds or even thousands of pages of financial data, but wish to find out if it's a good opportunity to buy Google or is it wise to sell Oracle in this particular situation. To find out which one of the two companies have an edge in the AI race, or wish to find out if Oracle is in a dead bubble or if Google is overhyped, the stuff you see across news channels is just the top layer. It's the tip of the iceberg. If you wish to find the real info, you need to dig deeper, but it's very time consuming and costly. But right now, you have the ability to leverage the power of AI in order to comb through this info in minutes, which would have taken a building full of analysts weeks. I mean, we are living in a super interesting time. If you have the right prompts and know the correct steps, then you can match a skyscraper full of analysts from your bedroom. For example, during my 2-hour analysis, I found that one of these companies is spending more on Capex than their entire cash balance and is funding it with debt. Meanwhile, the other one can easily finance its expansion using existing cash balance. And here's another shocker. One of these companies pays more than 4x the annual interest expense of the other. In this video, I'm not going to bore you with spreadsheets and raw numbers. I used AI tools like Notebook LM and Claude to handle the heavy lifting. This video is perfect for people with zero background in finance and for anyone who wishes to save time and leverage AI to think like a professional investor. At the end of this video, I'll share the prompt so that you can use the exact framework to analyze and compare between any of the hyperscalers. Now let's dive in. First, I downloaded 8 quarterly reports and relevant earnings call transcripts from their IR page. Then, I dumped them into Notebook LM. Notebook LM is super for parsing through thousands of pages, but you at least need to come up with the correct questions to ask. This is where we need Claude. I used Claude to build a framework on how I can analyze these two companies like an institutional investor or something like a hedge fund. So I asked Claude to build a framework which would allow the Notebook LM to think like a hedge fund analyst. In the second stage, Claude built a proper framework from the perspective of hedge funds or institutional investors. The framework was tasked to ask the questions that hedge fund analysts or institutional investors would ask on how to analyze these two companies in terms of debt burden, capex risk, and other factors. Once the framework was ready, I asked Claude to create a markdown file with the framework. Now, the reason I created the markdown file is because AI reads these files better than text documents. Then I fed the file, which is the prompt for the entire framework, into Notebook LM. The framework basically allows LM to think like a hedge fund analyst. By asking the right questions and doing the right calculations, it digs through all that data to come up with the right answers that you cannot find in a Bloomberg or a Reuters article. These answers will differentiate the winner from the loser. Oracle has a total debt of roughly $108 billion with cash of roughly $19 billion. So for every dollar Oracle has in their pocket, they owe $5 to someone else. Now let's look at Google. They have total debt of $48 billion with cash reserves of $126 billion. It's vastly different from the situation of Oracle. They're not just debt free, they have more cash than Oracle has in total debt. Imagine two people trying to build a house. Person A has 127 grand in the bank and owes 48 grand on a low interest mortgage. Now, person B has 19 grand in the bank and owes 108 grand spread across multiple high interest credit cards. Who would you bet on? But here's the kicker. Oracle's interest payments alone are $4.5 billion, close to $4.5 billion per year. That's 6 times that of Google's annual interest payments, which is huge. And it gets even worse. In September 2025 alone, Oracle issued $18 billion in new debt. They're not borrowing to expand, they're borrowing to survive. That's not a growth strategy, that's a Hail Mary. Now, the next question I asked, what's their free cash flow situation? Now, free cash flow is simple. It's the money left over after you pay all your bills, buy what you need to run the business. It's the most honest number in finance because you can't fake it with accounting tricks. Now, Oracle has operating cash flow of roughly 22 billion with capex of 35 billion, which gives them a FCF or free cash flow of negative 13.2 billion. So Oracle is spending $13 billion more than they are making every single year. Imagine a bathtub. Water is flowing in at 22 gallons per minute. That's their operating cash. But there's a drain at the bottom pouring out 35 gallons per minute. That's their capital spending. The tub is draining 13 gallons per minute faster than it's filling. Now, where does that missing water come from? More debt, more loans, more credit cards maxed out. Google, on the other hand, has operating cash flow of 115 billion with capex of roughly 91 billion, which gives them a FCF of 24 billion dollars. Google generated 24 billion in free cash after building their entire AI empire. They're not just surviving the AI race, they're printing money while doing it. Now, Oracle fanboys might argue that Oracle's betting on the future. Maybe all this spending will pay off. So I asked, what are the profit margins on this AI business both companies are building? So Oracle's traditional businesses, database software, enterprise apps had gross margins of 80 to 85%. That means for every dollar they made, 80 to 85 cents was pure profit after direct costs. But their new AI infrastructure business is generating roughly 30 to 40% of margins. They have cut their profitability in half chasing this AI dream. It's like you own a steakhouse where every $100 meal costs you $15 to make with $85 of profit. Life is good, but then you decide to open a burger joint next door where every $20 burger costs $12 to make with $8 of profit. You are working harder, serving more customers, but making way less money per transaction. And here's the brutal part. Oracle is replacing their high margin business with low margin business. Their traditional software revenues flat or decline. The only thing growing is the low margin cloud stuff. It doesn't end here. Google has a secret weapon. They build their own AI chips called TPUs or Tensor Processing Units. The latest one is called the Ironwood. And in their filings, they explicitly say these custom chips have significantly lowered machine costs for running AI, which means the inference cost. On the other hand, Oracle is buying NVIDIA GPUs at market price like everyone else. Commodity hardware, no cost savings, no innovation leverage. Google is like a mechanic who builds their own tools. They can customize everything for efficiency and save money. Oracle is renting tools from Home Depot every day, same job, way higher costs. I asked Notebook LM, show me how much these companies are spending on capex compared to how much their business is growing. Google's capex grew by 74% over 2024 to 2025. So they almost doubled their spending in just 1 year, while their revenue grew only by 15%. And their operating profit grew by 16% during the period. By Q3 of 2025, Google was spending 23.5% of their total revenue on capex. Almost a quarter of every dollar they made went straight into buying servers and building data centers. And in their earnings call, management literally said they plan to significantly increase spending in 2026. So the trend is getting worse, not better. Now let's look at Oracle. Oracle spent close to 36 billion while their operating cash flow was only 22 billion. So they spent 35 billion but only made 22 billion from operations. They're spending 160% of what they generate. Now let's talk about the revenue growth. Last year, their revenue only grew by 4%, even though OCI or cloud infrastructure services grew by 52%, but OCI, revenue from OCI merely represents roughly 20% of their entire revenue. So even with the 52% growth, that's only adding 5 to 6 billion in new revenue. Meanwhile, the legacy business, which is 40 billion plus, is declining or flat. So Oracle is barely growing. Now let's talk about profits. Remember those margins I mentioned? Legacy software business, 80 to 85% gross margins. OCI cloud business, 30 to 40% gross margins. So they're spending 35 billion to build a business that makes half the profit per dollar compared to what they already had. Now let's put all this together. They're burning through $17 billion more than they're making every single year. Where does the $17 billion come from? The answer is debt. In September 2025 alone, they issued $18 billion in new bonds just to keep the lights on. So, as you can see, this could be one of the reasons why Google's stock price is going up while Oracle's is going down. Okay, so we have already established that both companies are spending insane amounts on AI infrastructure. But here's something that kept me up at night after I saw it in the filings. I asked Notebook LM, how long do these servers and GPUs actually last before they're worthless? According to Google's own SEC filings, their computing equipment, servers, GPUs, all that expensive AI hardware has a useful lifespan of approximately 4 years. Oracle's filing says something similar, 3 to 4 years for compute infrastructure. Now, let me explain why this is terrifying. Google spent roughly 91.4 billion on infrastructure in 2025, out of which roughly 65% went into buying servers, GPUs, and networking equipment. That comes down to roughly $60 billion. Now, these equipment and NVIDIA GPUs have a lifespan of roughly 3 to 4 years, according to experts. So, their annual depreciation from this spending is roughly $15 billion per year. And it's about to get worse. If they spend even more in 2026, like they promised, that depreciation number is only going to climb up. Google expects to spend roughly 110 billion in 2026 in total capex, out of which 70 billion is expected to be spent on equipment, which will add extra 17 billion of depreciation per year. So by 2027, Google could be eating 35 to 40 billion dollars per year in depreciation charges. That's money that gets deducted from the operating income every single year. It's like buying a $90,000 sports car that loses 22.5 grand in value every year. After 4 years, it's worth zero. So you buy another $90,000 car and another. You are on a treadmill of constantly replacing depreciating assets just to stay in the same place. If Google is in trouble, Oracle is in a full blown crisis. The total capex for last year was close to $36 billion, out of which 23 billion went into equipment. With a lifespan of 4 years, the annual depreciation from the new equipment is roughly $6 billion. But here's where it gets brutal for Oracle. Remember, Oracle is already negative $13.2 billion in free cash flow. Now add additional $6 billion in annual depreciation, eating into their operating income. Here's what their P&L is going to look like. And it gets worse. In 3 to 4 years, all their equipment they're buying now needs to be replaced. So they will need additional $35 billion during 2028 to 2029 just to maintain the same capacity. Where is that money gonna come from? More debt. Always more debt. Oracle has 3 to 4 years to turn their $23 billion equipment investment into enough profit to pay back the investment, cover that 4.5 billion, close to $4.5 billion in annual interest payments, generate enough cash for the next round of equipment. Now let's see if that's even possible. So if their equipment investment is $23 billion, their cloud margins are roughly 30 to 40%. So the required revenue to recoup their investment is roughly 60 to $80 billion at 40% margin. Now, with our 3 to 4 year timeline, their required annual revenue should be $14 to $26 billion per year in new cloud revenue. Their entire cloud business is only about $10 to $12 billion right now. They need to more than double it and sustain that growth for 4 straight years just to break even. But wait, there's another layer to this nightmare. AI hardware doesn't just depreciate on paper, it becomes literally obsolete. GPUs from 2025 will be slower and less efficient than GPUs from 2029. Google's building custom TPUs to stay ahead of this curve. Each generation is more powerful and efficient than the last. Oracle, they're buying NVIDIA GPUs at market price. In 3 years, their chips will be outdated and they will have to replace them just to stay competitive, regardless of whether they have made their money back or not. It's like buying an iPhone 15 Pro Max for $1,200. In 4 years, it still works, but it's so outdated compared to the iPhone 19 that you basically have to upgrade. Except instead of $1,200, we are talking about $60 billion of Google and $23 billion for Oracle. If Google can't generate enough revenue growth to offset that depreciation, here's what happens. Their operating margins shrink. They're forced to keep spending more on Capex just to maintain AI competitiveness. Free cash flow declines, and eventually they have to either cut spending or accept lower profitability. However, this won't bankrupt them. They have $127 billion of cash in reserves. But it means that AI investment was a losing bet. On the other hand, for Oracle, the stakes are existential. If cloud revenue doesn't hit targets in 3 to 4 years, they can't pay back the debt. Depreciation accelerates, margins collapse further, interest payments become impossible to cover from operations, credit rating drops, making new borrowing more expensive, and eventually default, restructuring, or forced asset sales. It's not hypothetical, it's math. They have 3 to 4 years to prove their work or they're toast. And here's the thing, we have seen this movie before. In the early 2000s, telecom companies spent hundreds of billions laying fiber optic cables during the dot-com boom. Everyone said bandwidth is the future. Then the bubble burst. Companies like WorldCom, Global Crossing, and Level 3 went into bankruptcy. All that fiber still in the ground, but it depreciated to zero on the balance sheet while they're still paying off the debt. Right now, Google and Oracle are laying the fiber optic cables of the AI era. Except this time, it's data centers and GPUs instead of cables. If the AI revolution is as big as promised, they will be fine. But if demand doesn't materialize or if the technology shifts faster than expected, they will be sitting on billions of dollars worth of depreciating assets that never paid for themselves. Now, Oracle defenders will say, but wait, Oracle has a $523 billion backlog of contracted future revenue. They're going to make all this money back. So I asked Notebook LM, how fast is that backlog actually converting to real revenue? Oracle has $523 billion in something called RPO, Remaining Performance Obligation. It's basically contracts they have signed with customers for future services. Sounds great, right? $500 billion in guaranteed revenue. They expect to recognize only $52 billion of that as actual revenue within the next 12 months. That's 10% of the backlog. The rest is spread over years, maybe decades. So let's do the math. They're spending $35 billion per year on infrastructure plus $4 billion per year on interest payments. That's a $39 billion spending going out annually. But they're only converting $52 billion from the backlog into revenue. Even if all of that $52 billion was pure profit, which it's not, they're barely covering their costs. And remember, their margins on cloud business are only 30 to 40%.
Gemini 3 Flash
so that
can help you
$52
get things
billion
done in
in
minutes.
revenue
Let's
is
say I own a
really
gym.
only
I can
$15 to
upload a
$20 billion
spreadsheet
in
of
gross
customer
profit.
requests and
It's
ask
like
Gemini
someone
what's the
saying,
number
I
one
have
thing they're asking for.
$500,000 in
Gemini
future
then breaks
commissions
down
from
all
my
the
sales
feedback.
job. But
Looks
they're
like the amount of
spending
classes are one of the
$40,000 a
biggest
year
requests.
right now on car
So let's
payments
ask
and credit
Gemini to
cards.
build a solution
And
relating
they're
to classes
only
and develop a
collecting
30-day
$50,000
fitness
of those
challenge and a
commissions
promotion
this
that
year.
fixes these
Eventually,
issues.
the math catches
Gemini
up.
then builds out a
Now,
robust plan
just
to
when you
offer gym
think
goers
Google has
exclusive
this in the
benefits to
bag,
classes outside
here
of
comes
peak
the
hours.
curveball.
I want
I
to create a
asked,
marketing email
what
for this new
legal
plan.
or regulatory
So I
risks
upload my gym's
do these
brand guide
companies
to reference
face?
the tone and voice
Google's
and add my
nightmares
prompt.
involve
I'll enable
$3.5 billion
Canvas
of fine
and hit
from
go.
EU in 2025
With my
for
email
advertising
created, the last
practices,
step is to create a landing
$1.4
page
billion
for when people want
settlement
to
for
click on the
privacy
link in my email.
violations. But here's the real
And
killer.
with the web page
December
generated, I'm
2025
good to
court
go.
ruling.
I can even
A
ask
federal
Gemini to make
judge
any
ruled
further
that
changes
Google
for
must
copy
share
or
its
design
search
to get
data
just
with
right. Then
competitors
I can
and
copy
face
the code and
restrictions
quickly
on
apply this
how
to
it
my actual
distributes
website.
Chrome
And
and
that's how you can
Android.
turn hours of work
Why is it
into minutes.
existential? Google's entire moat, their entire competitive advantage is being the default search engine everywhere. On your iPhone, on Android, on Chrome. You don't choose Google, it's just there. Now, they have to share their data and can't pay Apple billions to be the default anymore. That's like Coca-Cola being forced to give Pepsi their secret formula and give up their shelf space at every gas station. Oracle's advantage involves no major regulatory scrutiny. They're too small, too boring, too under the radar. In a weird way, being the underdog might actually help them here. So Google has all the money, all the tech, all the advantages, but the government is literally trying to break them apart. Google is a heavyweight champion dealing with injuries and regulators trying to tie weights to their ankles. But they're still strong.
Okay,
they can take
what
the
should we
hits.
build next?
Oracle, on the other hand, is a challenger who borrowed millions to afford the training camp. If they win the championship fight, they're legends. If they lose, the creditors are waiting outside the ring with baseball bats.
The first time I saw the campus,
the market knows this.
It was incredible.
That's why Google's stock price is up and Oracle is tanking.
You see people walking.
And I found all this in about 10 minutes using Notebook LM and Claude. No Bloomberg terminal, no CPA license, just the right questions. I spent hours fine-tuning my prompts to ask the right questions, but it took less than 10 minutes to get all the answers. I have shared the prompt in the description. If you found this video useful, then please like and subscribe, because it takes a lot of effort to create this video.